In this video, we are going to study pro forma financial statements and sales-driven forecasting. This is one of the most practical topics in corporate finance because it connects strategy with numbers. A business may say, "We want to grow." That sounds exciting, but finance asks a deeper question. What will that growth require? Will the firm need more inventory? Will it need to extend more credit to customers? Will it need more equipment, more employees, more cash, or more financing? That is why financial planning is a forward-looking discipline. It is not just about recording what happened in the past. It is about translating future plans into projected financial consequences. A financial forecast is not simply a prediction. It is a structured set of assumptions. A good forecast makes the business logic visible. It shows how sales are generated, how costs behave, how assets are required, how working capital changes, and how financing needs appear. Pro forma financial statements are projected financial statements. They usually include a projected income statement, a projected balance sheet, and a projected cash flow estimate. By the end of this video, you should understand how growth, profitability, assets, liabilities, retained earnings, and financing needs all fit together. Let's begin with the basic pro forma sequence. The most important idea is that the income statement, balance sheet, and cash flow forecast should not be built separately, as if they are unrelated documents. They are connected. A useful forecast usually begins with sales. Sales are often the starting point because many parts of the business depend on the level of revenue. After sales, we forecast operating performance. This means we think about margins, operating expenses, depreciation, interest, taxes, and ultimately projected net income. Then we forecast operating assets. If sales increase, the firm may need more cash for transactions, more accounts receivable, more inventory, and possibly more fixed assets. Next, we forecast spontaneous liabilities. These are liabilities that arise naturally from operations, such as accounts payable and accrued expenses. Then we forecast retained earnings. This depends on how much profit the firm keeps inside the business rather than paying out to owners. Finally, we identify the financing plug. This is the gap that appears when projected assets are compared with projected liabilities and equity before new financing. This sequence teaches a powerful lesson. Sales growth starts the story, but the balance sheet tells us whether the firm has the financial capacity to support that story. In finance, growth is not only an income statement issue, growth is also a balance sheet issue and a cash flow issue. Let's now focus on sales-driven forecasting. Many financial plans begin with a sales forecast because sales are often the primary driver of operating activity. A sales forecast may come from many sources. It may reflect market demand, pricing strategy, expected sales volume, customer acquisition, customer retention, competitive conditions, capacity limits, or management strategic goals. But here's a very important warning. Sales-driven forecasting does not mean that every account automatically moves with sales. Sales provide the organizing assumption for the model. After that, the analyst must decide which accounts are truly connected to sales and which accounts require separate assumptions. This is where the percent of sales method becomes useful. The percent of sales method forecasts selected accounts as a percentage of sales. It is simple, transparent, and very helpful for building an initial forecast. But simplicity is both its strength and its weakness. Some accounts are often linked to sales, such as accounts receivable, inventory, accounts payable, accrued expenses, and variable operating costs. Other accounts may require separate judgment, such as excess cash, fixed assets when capacity changes in steps, depreciation, taxes, interest expense, and some parts of selling and administrative expenses. Still other items are usually financing policy decisions, such as debt, equity issuance, dividends, and share repurchases. So the lesson is this: a good forecast combines formulas with judgment. The model should be simple enough to explain, but realistic enough to reflect how the business actually operates. Next, let's discuss forecasting the income statement. The income statement forecast estimates the profitability of the plan. It usually begins with sales and then applies assumptions about costs, expenses, depreciation, interest, taxes, and payout policy. Sales are often the main driver, but the analyst must be careful with each line item. Cost of goods sold may be related to sales, but margins can change. Pricing may change. Input costs may change. Product mix may change. The firm may benefit from scale, or it may face higher costs as it grows. Selling, general, and administrative expenses also require judgment. Some of these expenses may vary with sales. Others may be fixed, step fixed, or discretionary. This is where operating leverage matters. If a firm has fixed costs, sales growth can improve profitability. But if the forecast assumes all expenses move smoothly with sales, it may miss the real economics of the business. Depreciation depends on the asset base, capital expenditures, and depreciation policy. Interest expense depends on debt levels and interest rates. It is usually a financing assumption, not an operating assumption. Taxes depend on projected taxable income and the relevant tax rules. Dividends affect retained earnings rather than operating income. The income statement gives us projected net income, but net income is not the same as cash available for growth. That is why the balance sheet and cash flow forecast are essential. Now we move from profitability to financing through retained earnings and the balance sheet. Projected net income affects the balance sheet through retained earnings. When a firm earns profit, it can either distribute some of that profit to owners or keep some of it in the business. The portion kept in the business increases retained earnings. Retained earnings are important because they represent internal financing. The more earnings the firm retains, the less it may need to rely on new external capital, all else equal. But retained earnings are only one part of the financing story. The balance sheet forecast estimates the assets required to support the sales forecast and the liabilities and equity available to finance those assets. Operating assets commonly include cash needed for transactions, accounts receivable, inventory, and fixed assets used in production or service delivery. When sales grow, these assets often must grow as well. At the same time, not all liabilities come from formal financing decisions. Some liabilities arise naturally from operations. These are called spontaneous liabilities. Accounts payable and accrued expenses are common examples. Spontaneous liabilities can partially finance growth because suppliers, employees, and other operating obligations may create temporary financing. However, spontaneous liabilities usually do not finance the entire increase in assets. The remaining gap must be covered somehow. That gap may be handled through retained earnings, borrowing, equity issuance, reduced dividends, improved operations, slower growth, or a combination of these choices. This brings us to one of the most important ideas in pro forma forecasting, the financing plug. A projected balance sheet must balance. If projected assets are greater than projected liabilities and equity before new financing, the firm has a financing need. That gap is often called the financing plug. The word plug can make it sound mechanical, but it should not be treated as an afterthought. The financing plug is a managerial signal. It tells us whether the growth plan is financially feasible under the assumptions we are using. A positive financing plug means the firm needs additional financing or must revise the plan. A negative financing plug means the plan produces more financing than needed for projected assets. That may create excess cash, debt repayment capacity, share repurchase capacity, or additional investment capacity. The key point is interpretation. The forecast does not automatically say that growth is good or bad. It tells management what the growth plan requires. If a financing need appears, managers have choices. They might arrange borrowing. They might issue equity. They might reduce dividends. They might improve collections from customers. They might lower inventory intensity. They might negotiate better supplier terms. They might improve margins, or they might adjust the growth target. This is why pro forma forecasting is not just spreadsheet work. It is a disciplined conversation about strategy, operations, financing, and feasibility. A strong forecast separates operating assumptions from financing assumptions. This distinction is extremely important. Operating assumptions describe how the business works. They include ideas such as sales growth, margins, operating expenses, receivables collection, inventory levels, supplier terms, and capacity needs. Investment assumptions describe the asset base needed to support the operating plan. They include capital expenditures, replacement assets, expansion assets, depreciation, and capacity utilization. Financing assumptions describe how the firm chooses to fund the plan. They include borrowing, debt repayment, equity issuance, dividends, share repurchases, target cash balances, and interest rates. Risk assumptions describe uncertainty around the forecast. They include demand uncertainty, input cost uncertainty, credit risk, supply chain risk, interest rate risk, and inflation risk. Why does this separation matter? Because forecasts can become circular. For example, interest expense depends on debt, but debt may depend on the financing need, and the financing need may depend on net income after interest. This creates a loop. Analysts often handle this by starting with an initial estimate, applying a financing policy, and then revising the forecast until the financial statements are internally consistent. The purpose is not to pretend the future is perfectly known. The purpose is to make assumptions clear, logical, and testable. A forecast becomes valuable when decision makers can see what is driving the results. Let's now connect pro forma statements to cash flow. Projected accounting income is useful, but managers also need to understand projected cash flow. A firm can report profit and still experience pressure on cash. Why? Because growth often requires investment. The firm may need to build inventory. It may need to extend credit to customers. It may need to purchase equipment. It may need to expand facilities. It may need to hire people before the full benefit of growth appears. This is why cash flow analysis is so important. Common free cash flow structure starts with operating profit after tax, adjusts for non-cash expenses, and then subtracts investment in working capital and capital expenditures. That structure reminds us that growth can be profitable and cash-consuming at the same time. Depreciation is included because it affects accounting income, but is not itself a current cash outflow. Changes in net working capital matter because receivables and inventory can tie up cash, while payables and accruals can provide partial operating financing. Capital expenditures matter because fixed assets often require real cash investment. The cash flow forecast helps managers answer a critical question. Is the growth plan self-funding, cash-consuming, or dependent on external capital? That question often separates an attractive growth story from a financially sustainable growth plan. Let's now connect growth to profitability and investment needs. Growth affects the firm through several channels at the same time. Higher sales may increase gross profit, operating income, and net income. But the same sales growth may also require more inventory, more credit extended to customers, more production capacity, more employees, more systems, and more cash for operations. So the financial effect of growth depends on several important drivers. Profit margin matters because higher margins generate more internal funds from sales. Asset intensity matters because some firms need many assets to support growth, while others can grow with a lighter asset base. Spontaneous financing matters because supplier credit and accrued expenses can partially support growth. Retention policy matters because retained earnings reduce the need for new external financing. This explains why a profitable firm can still face a financing gap. Profitability creates internal funds, but growth consumes funds when the firm must invest in additional assets. Capacity is also critical. The percent of sales method works best when assets and liabilities move smoothly with sales. In real life, many assets are lumpy. A firm may be able to grow using existing capacity, but once capacity is reached, it may need a major investment before it can grow further. Scale can also change margins. Growth may improve efficiency, purchasing power, and labor utilization. But rapid growth may also create overtime costs, quality problems, shipping pressure, customer service issues, or managerial complexity. A good forecast reflects these realities. Before we finish, let's review common forecasting pitfalls. Forecasts are useful because they simplify reality, but they become dangerous when we forget that they are simplifications. One common mistake is assuming all costs vary with sales. Some costs are fixed, some change in steps, some are discretionary. Another mistake is ignoring capacity. Sales growth may not be possible without new investment in people, systems, equipment, or facilities. Another mistake is treating financing as automatic. A forecast may show that the firm needs debt or equity, but that does not guarantee capital will be available at acceptable terms. Another mistake is confusing profit with cash. A firm can report net income while cash is tied up in receivables, inventory, or capital expenditures. Analysts may also rely too heavily on historical ratios. Past relationships may not hold if strategy, pricing, customers, technology, or supply conditions change. Seasonality is another issue. Annual forecasts can hide periods of tight liquidity during the year. Finally, rapid growth may strain managerial capacity, internal controls, employees, suppliers, and customer service. So remember the main purpose of a forecast. It is not to create a perfect spreadsheet. It is to create a disciplined conversation about assumptions, constraints, trade-offs, and financial feasibility. Thank you for joining me today. I look forward to seeing you in the next video.